Hello and welcome back to another series of lecture videos for financial accounting. In this chapter, we're going to look at Chapter 9, and Chapter 9 talks all about long-lived assets and intangible assets. So as we progress through the book, we've already talked a lot about assets, right? We looked at how do we account for receivables. We looked at cash and internal controls and cash controls. And in this chapter, we're going to talk about, again, those long-lived and intangible assets. And this is the last chapter that deals with the asset portion of the balance sheet. As we move into Chapter 10 and Chapter 11, we're going to look at liabilities, and we're going to look at stockholders' equity. So when we talk about long-lived assets, it's kind of a goofy name, right? Long-lived assets. What does that mean, right? Basically, we're talking about our property, plant, and equipment, okay? And when we talk about intangible assets, those are assets that we own or that we have control over that really don't have any physical substance to them. We can't touch them, we can't use them, but nonetheless, they still provide us value for the company. And when we get into intangible assets, we'll elaborate a little more and identify, what we mean by intangible assets and provide you with some examples. So let's jump in and let's talk about long-lived assets. So basically, in this video, we're going to talk about property, plant, and equipment, and we're going to see how do we account for those and how do we measure them. Pretty simple, okay? So, like we already mentioned, we have two categories of these long-lived assets. We have property, plant, and equipment. That's any asset that's any revenue-generating asset, right? Obviously, the plant is an asset, but everything that goes in the plant could also be an asset. Things like equipment, cars, or vehicles that we use to provide a service or to generate revenue. Those are all examples of plant assets. When we're talking about intangible assets, again, these are the things that don't have a physical substance, but they give us protection, right? Well, what do you mean by that? Well, think about U.S. patents, right? Patents, trademarks, copyrights, goodwill, and we'll talk about that when we get to it. That legal protection helps us to generate revenue, okay? Think of the Nike swoosh, right? That's trademarked by Nike, right? So Nike can sell shoes with their little swoosh, and nobody else could steal that emblem and put it on a tennis shoe or a sneaker or whatever and sell it. Okay. So again, when we're talking about plant assets, we're talking about the pp&e, right? That's anything from land that the building sits on, the buildings, the equipment that are in the buildings, and any furniture or fixtures that we may have. Think about, I don't know what stores you guys like to shop at. So I'll be sexist here for a minute and just say Dick's Sporting Goods, right? Well, they have women's clothes there too, so yeah, we're good. All right, anywho, think about if you walk into a Dick's Sporting Goods, right? They have racks. They have, if anybody has ever worked in retail, gondolas, right? Basically, it's just the thing that they hang merchandise on. That's furnitures and fixtures, okay? And that's an asset to Dick's Sporting Goods, and they use those furnitures and fixtures to help generate revenue, right? They hang the t-shirts and the sweatpants and whatever else they sell on the racks so they can sell them. So again, when we're talking about those intangible assets, it is an economic resource, right? It provides benefit for the company, right? Specifically, some of these or actually the majority of these are all going to be legal protection, right? We have the right to produce this music or sell this music that we created, or we have the right to manufacture this pharmaceutical drug and sell it, and nobody else can take our recipe, so to speak, right? So those intangible assets, like I said, they do lack substance, right? Meaning there's no physical, you can't touch them, you can't feel them, whatnot. So when we talk about intangible assets, we're looking at things like copyrights, trademarks, patents, franchises. So when we're looking at these long-lived assets, right, and these account for, in the beginning, we're really going to talk about the property, plant, and equipment, right? So we need to think about, okay, how are we going to, from an accounting standpoint, how are we going to value these things? How are we going to put them on our books? How are we going? What happens when we get rid of them? How are we going to get them off our books? And then remember, all through this course, we've been talking about accrual accounting, right? And accrual accounting says we need to match up an expense or the expense with the revenue that expense helped to generate. Okay, great. Well, how do we expense an asset? Because when we first buy an asset, we debit, fixtures and furniture and fixtures, or we debit equipment and we credit cash. Nowhere up to this point have we looked at how do we expense that, right? And we kind of talked a little bit about it when we did our adjusting entries and we got into depreciation. So we're going to build off that idea of here's depreciation, and we're going to look at how we calculate that depreciation and actually really explain it a lot more, okay? So what we have here are how do we actually record a long-lived asset, right? We buy equipment, we buy a building. How do we record that on our books, right? Well, we record it at the acquisition cost, right? Meaning, what did we pay for it at that particular time, okay? We call that historical cost. Now, it's important to recognize that when we calculate, or when we really not calculate, we're taking the historical cost from the legal documents or the receipts or whatever that says, hey, here's how much you paid for it. But what we need to recognize is that when we're looking at historical cost, we're including everything that we used or that we gave up to get that asset, right? Meaning, we include any cash or cash equivalents that we gave up to get that asset. And we also include any costs that we incurred to get it ready and to get it, or to get the asset ready for its intended use. Okay, what do you mean by that? Well, let's think about it. Okay, we buy a piece of equipment, and let's say that the invoice for this piece of equipment is $10,000. Okay, great. We get a cash discount. They give us $210 or $110 net 30. Okay. So we pay for it within 10 days, we get that discount. We buy a piece of equipment, we have to pay sales tax on that, right? And let's say the sales tax $500. So what is the purchase price of this piece of equipment? Well, it's not $10,000. Why isn't it $10,000? Well, because we got a $100 discount on it, okay? That's number one. So it should be $9,900. Nope, shouldn't be $9,900. We had to pay sales tax on that asset. We need to include that sales tax as part of its acquisition cost or its historical cost. So we add the taxes of $5,000. So we see that we have the asset cost $10,400. But we're not done, right? Remember, we said that what do we initially measure the asset at? Well, we initially measure, we put it on our books for the acquisition cost, plus any costs that we incur to get this machine to us or to get this asset to us and to get it ready for service, okay? So, at the end of the day, we leave the the store and we bought an asset and it cost us $10,400. But it has to get to us, right? So there's freight charges included in that. Once we get it to us, we have to incur more cost to install the machine. Then once we get the machine installed, we're going to incur more costs so we can actually test the machine, make sure it's ready to go. So we take all those related expenditures of getting the machine to us or getting the equipment to us, installing the equipment, and getting that equipment ready for use by testing it and things like that. So we see that the acquisition cost of equipment is actually $11,400. The key takeaway here is, what do I include in the cost of a new machine that I buy or a new long-lived asset? It's the purchase price plus any other cost that we incur to get it to us and to get it ready to use. Okay? So a lot of times we can make packaging or a package purchase, right? And basically what we say here is that, you know what, I'm going to buy your entire business, okay? I'm going to buy your land. I'm going to buy the building that's on that land. And I'm also going to buy all that equipment in it. Okay, great. Well, we have 3 different assets that we paid one big price for, okay? We need to break this thing apart, right? Because land, building, and equipment are all treated differently when it comes to depreciation. Land never, ever, ever depreciated, right? Building's probably going to have a different useful life than our equipment. Equipment's going to have a different useful life, right? And each of those are going to be, depreciation is going to be calculated differently for each of those. So what we need to do is we need to break this thing apart. Okay, how do we do that? Well, we just basically allocate it based on the market value or the appraisal value. Okay, so let's think about it this way. We bought 3 assets, and let's say that their estimated market value is $200,000. Okay, so when we look at each of the market values of what we paid, right? So land is $60,000, buildings $120,000, that equipment's $20,000. So that total equals $200,000. What we need to do is we need to say, okay, what percentage are each of these assets of the total market value? So we just take 60,000 divided by 200,000, we get 30%. Same thing with 120,000 divided by 200,000 at 60%, and then 20,000 divided by 200,000, that is 10%. So then what we do is we multiply each of those percentages by the purchase price, okay? So the purchase price we actually paid was $190,000, but the estimated market value of the equipment was $200,000. So what we're going to do is we're going to multiply our purchase price by each of the percentages. And we see that we're going to put land on our books for $57,000. How do we get that? The 30,000 times the 190,000. We're going to do the same thing with building. Building makes up the market value of the building makes up 60% of the total purchase price. So 60 times 190,000, we get $114,000. And then we do the same thing with the land, right? The land is basically, we're going to allocate 10% of the purchase price to the land, okay? So another thing we need to look at is land, right? What costs do we put land on the books for? Now this is completely different than the package purchase, right? This is saying we're going to buy a plot of land, okay? What do we put it on our books for? Well, the land is valued, obviously, at its initial purchase price, but we have to include other taxes as well, okay? We have to include other costs as well. So let's say we buy a piece of land for, I don't know, $10,000. What do we put it on our books for? Well, we're going to put it on the book. $10,000 is going to be part of that, but there's also going to be property taxes on the purchase. There's going to be insurance on the purchase. There's going to be legal fees on the purchase, right? Those get included in the land, the price of the land that we record on our books, okay? Now, let's say that there's a little crappy shack on our land that we're buying, and what we want to do is we want to build a store on that, okay? So there's this little crappy building, right? Little shed, little shack, whatever. We need to get that off the land, right? We want to bulldoze it down, and so we can build our own store. The cost that we incur to remove that building is also included in the price of the land, okay? Meaning, when I say the price, I mean what we put it on our books for, the acquisition cost, okay? If we have to have any special assessments, if we have to have somebody come out and take a survey of the land or something, that cost becomes part of the acquisition cost, okay? Remember that the land, anything that we do on the land is totally different, right? So we say land by itself has an indefinite life. We never depreciate it. It never decreases in value on our books. Whatever the acquisition cost is, that acquisition cost includes property taxes, insurance, legal fees, any cost that I incur to get that land ready for use, okay? We're going to put stuff on this land. Maybe we're going to put a driveway. Maybe we're going to put a parking lot. Maybe we're going to put up some parking lot lights. We call those land improvements. Those land improvements do have limited life, okay? And we account for those separately, even though they go on the land. In the accounting books, they're accounted for separately, okay? Same thing with leaseholder improvements, okay? Let's say we're leasing the land and we tell the landlord, hey, we want to put some bushes and shrubs and make our parking lot bigger or whatever. The landlord says, no problem, go for it. That's a leaseholder improvement, and we put those on our books separately as well, okay? So let's just look at a quick check, right? Sienna Corporation paid $30,000 for a new specialized machine, okay? In addition, Sienna paid $600 in transportation for the equipment to get it installed in its location. They paid an additional $300 to have the equipment professionally installed. Sienna expects the new machine to lower operating costs by $5,000 within the first year. What's the amount that Sienna should show as the cost of the equipment? Meaning, what are we putting it on our books for? Well, hopefully after just looking at this, you look at it and you say, okay, well, I remember what he said. I jotted down in my notes. It's the initial cost plus any cost that I incur to get that asset to me and get it ready for, get it ready to start producing revenue, right? Or get it ready to start working. So we're going to include the $30,000, definitely going to include the $600, and we're also going to include the $300. So we should have it on our books at $30,900. Okay? When we come back, we're going to talk about depreciation, specifically the depreciation methods that we have. Up to this point, they just basically told us, here's your depreciation, or depreciation for the year is X. Break it down monthly, right? In this, or in the next video, we're going to see exactly how do we calculate depreciation. What are those three methods? So, the real key takeaway from this little video here is being able to identify long-lived assets, right? We have either plant assets or intangible assets. Know what's included within each of those categories, right? Plant assets, we're talking about the pp&E, property, plant, equipment. So land, building, equipment, furnitures and fixtures, those are all part of plant assets. Know what the intangible assets are, right? Remember, We get an economic benefit from having these, but they don't have any physical existence. Things like copyrights, trademarks, patents, franchises. Okay, so we know, since we finished the video, what we mean by all these accounting issues, right? How do we account for the acquisition cost, right? How do we expense the assets cost over time? We're actually going to look at that in our next video, right? How do I determine the treatment of future expenditures on original assets? We did talk about that. We looked at land, right? Those land improvements. That's what we're talking about here, right? If we have a future expenditure on the original asset, that adds value to the asset, but we need to keep it separately, okay, or keep track of it separately on our accounting books. We'll get into accounting for the disposal of asset towards the end, but very important knowing how to calculate that long-lived asset cost, that initial cost or that historical cost. If you're able to realize that package purchases, we have to pull everything out and calculate or allocate the price of each of those items, you're good. We did talk about expenditures related to land. Okay, so we come back, we're going to look at these depreciation methods.